Becton Dickinson is dropping, but is that a red flag or an opportunity? At Insightful Value, we uncover what others overlook, and today we're looking at a healthcare giant that's taken a hit. This video is for informational and educational purposes only. None of this is financial advice. Becton Dickinson and Company, often known as BD, is a global leader in medical technology. They produce and sell medical devices, laboratory equipment, and diagnostic products. Think syringes, blood collection systems, infusion pumps. BD products are everywhere, even if you've never noticed the brand name. Despite being a staple in healthcare infrastructure worldwide, BD stock has been under pressure lately. The big question is, why? Let's break it down. BD recently released its earnings, and while revenues continue to grow steadily, clocking in over $19 billion annually, investors are reacting to compressed margins and slower profitability growth. Gross margins remain healthy, but have slightly declined due to rising manufacturing costs and currency pressures. Operating margins are hovering just above 17%, and net margins have been stuck in the 7 to 8% range. One key concern: BD's high debt load, a remnant of previous acquisitions like Bard and CR Bard. The debt isn't crippling, but it limits flexibility and raises questions about future capital allocation. That said, BD has a long history of delivering consistent earnings, and it generates robust free cash flow, enough to cover dividends and reinvest in R&D. Speaking of dividends, BD pays a modest yield of just under 1.5%, with a history of over 50 consecutive years of dividend increases. That makes it a dividend aristocrat, a rare status that should matter to long-term investors. In terms of valuation, BD is now trading below its historical averages. The price-to-earnings ratio has come down to around 18, and the price-to-free cash flow is under 20, which makes it interesting for value-focused investors. Especially when you consider the essential nature of their products, this isn't a trendy tech company. It's the backbone of global healthcare. BD also recently announced restructuring efforts aimed at simplifying operations and driving better margins. Plus, the spin-off of Embecta, its diabetes care business, allows it to concentrate more on high-margin segments like biosciences and diagnostics. That's a big deal in terms of strategic clarity. So, is BD in trouble or just in transition? From a value analysis standpoint, this might be a temporary mispricing. Investors spooked by short-term issues could be missing the long-term fundamentals. BD isn't flashy, but it's built on recurring demand, strong IP, and massive scale advantages. At Insightful Value, we provide in-depth analysis of companies like BD that might be flying under the radar. We break down the key data and explain why these companies are worth considering without the jargon. Whether you're a seasoned investor or just starting out, our goal is to give you clear, actionable insights. You can find more deep dives like this at InsightfulValue.com. We're building a community of smart, value-oriented investors who look beyond the headlines. If you found this video helpful, hit that subscribe button and don't forget to check out our site at InsightfulValue.com for more insights.